The topic for today's webinar is on personal financial statements. Right now, most of us are familiar with statements of a particular company, right? And sometimes we don't actually look at our own personal financial statements. For example, in case of the company, you have a balance sheet, an income statement, a cash flow, right? And we have format and structure and rules and regulations for making a balance sheet for a company, as well as there are some ratios and some methods by which you can assess a company's financial health. Now, if you can assess a company's financial health, why not a situation where you can assess the health of a particular individual? Now, how many of us have actually ever sat down and actually made a balance sheet for our own assets and liabilities, and one would be able to really understand that we may actually have much more than what we have expected, and possibly this may actually help us to understand our financial situation quite well. Like a company, we could also make a balance sheet, we could also make a income statement, and we could also make a cash flow statement, right? So like a company, a balance sheet is basically a statement of the assets and the liabilities, whereas an income statement is basically a statement where it shows the income and the expenses, and a cash flow statement is basically in terms of how your cash flow over a period of time works out, right? Now, if a particular financial planner is really supposed to make a correct assessment of your financial situation and help you to plan, he needs to first make a personal balance sheet and an income statement, right? Because until unless he does not figure out where you are, right, he cannot figure out where you are going to be, right? At that point of time, he needs to correctly assess, right, the kind of assets that you have, the quality of the assets that you have, right? Secondly, in terms of what are your sources of income, what are your sources of expenses, whether there is surplus or not. And thirdly, that you may be having some cash expenses, you may be having some goals which you really need to pay in cash. So until unless there is an adequate amount of liquidity, nothing is going to work out, right? So therefore, in order to assess a person's financial situation, three basic statements are required and are very, very necessary. That is a balance sheet, a statement of income and expenditure, and third is a cash flow, right? Now, when I say a balance sheet, as I earlier mentioned, is a statement of the assets and the liabilities. Now, what kind of assets are we looking at? Now, assets can broadly be divided into three categories, right? One is your household, your lifestyle assets. Second is your liquid assets. And the second is your investment assets. Now, when I say liquid assets, right, which is basically those, for example, you may be having cash, some short-term securities like money market mutual funds, or you may have invested in a certificate of deposit or commercial paper, or if you're a high net worth individual, possibly even in a treasury bill. So basically, when we are looking at liquid assets, we are basically looking at those assets which can be converted into cash very, very fast. Household and lifestyle assets are basically, for example, of a kind of fixed assets or immovable assets, which we normally take as maybe a house, maybe some furniture, maybe some electronic gadgets, maybe a motorcycle, maybe a fridge, right, a bit of your jewelry. So all which are related to real estate, or which maybe a music system, all those particular assets which are immovable and which may not have an immediate market, right? So the liquidity of these assets are low, and they may be subject to some sort of a depreciation as well, right? Jewelry is also, as I said, included, right? Then lastly, you have assets which are investments in assets, and which are very critical to your investment strategy. Now, investment assets are basically in terms of, let's say, mutual funds, debentures and bonds. Then you may be having some equity, then you may be having some assets like exchange traded funds, or all those kind of assets which can be, you hold a particular claim right? So you may also have some non-security forms of investment. For example, you may have a public provident fund, you may have an employee provident fund, you may have Kisan Vikas Patras, you may have a post office savings account, right? So all those accounts which have a slightly duration of, they have limited liquidity, right? But they do have liquidity much more than your household assets, right? But they are evidenced by a ownership to claim, and they are not physical in nature. You cannot touch them. Now, whereas when you talk about liabilities, now liabilities can broadly be divided into two categories. One category is again current liabilities, and the other is long-term liabilities. Current liabilities are basically if you have any short-term loans or maybe something to do with your credit card bill. Whereas long-term loans, which basically relates to, let's say, your house loan, if you have taken a personal loan, if you have taken a car loan, right? So all those mortgages or loans that you have taken for meeting your various purposes, that is basically in terms of your long-term liabilities. Your assets minus liabilities is called your net worth. Now, the objective of every financial planner is to ensure that over a period of time, the net worth of a person goes up. That is, the assets minus liabilities must go up. Of course, a certain amount of liquidity needs to be taken into account. Now, for the net worth to go up, now either the market value of assets goes up or the market value of liabilities go down. That is one way of increasing your net worth. The other way of increasing your net worth is to ensure that whatever surplus that you have after meeting all the expenses goes towards building up your assets. For example, if you have, let's say, income of, let's say, 5 lakhs rupees a year, and let's say you have, in order all your expenses, your household expenses included, etc., this is 3 lakhs. That 2 lakhs can go towards building up an investment portfolio. So you may decide to buy stocks, shares, mutual funds, maybe some post office bank deposits or some bonds in terms of government bonds, and a periodic investment in all these assets would go towards a long way increasing your net worth, because over a period of time not only would you add to the value of these assets, but in terms of the market value also at times would also tend to go up, especially in investments like equity. Then of course is a cash flow statement. Now when you are looking at your income and expenditure statement, you are looking at all sources of income and you are looking at expenditure. When you are looking at expenditure, you probably may need to divide it into heads. For example, you may have a grocery or section, you may have a utility section, you may have a children section, you may have an entertainment section, you may have a entertainment section, you may have something to do with cosmetics, or you may have a section which is related to medical care and doctor's expenses. So by dividing these categories of expenses, sometimes it becomes important to analyze that where, in which direction your expenses are geared towards. So by dividing these expenses in various heads, one gets an idea that where the percentage breakup of where I am going to spend my money or where I am spending it can be analyzed. Similarly for your sources of income also, right? So for example, you may be getting something from consulting, something you may get from your house rent, something you may be getting from your salary. So again, a percentage breakup of your sources of income again goes towards an understanding that where your income is coming from, right? Now in terms of the cash flow, right, that is also important because for example, to determine, let's say, your life insurance needs or your retirement needs, so you need to make an analysis of where your cash flows are coming from and where do you want to spend your cash flows. Now you may have different objectives in terms of sending your child to school or for higher education, for retirement. So those blocks of expenses, right, and in terms of where your cash is coming from, because most balance sheets are based on accrual. So a cash flow statement is also very, very essential in determining the actual liquidity that you would have at a given point of time. Now when you analyze your balance sheet, right, now there may be numerous ratios that one can use while analyzing a balance sheet. Now some of these ratios are basically one is a liquidity ratio, one is a debt ratio, and one is a savings ratio, and there may be other ratios that one may use. Now savings liquidity ratio is nothing but liquid assets divided by current liabilities. Basically that gives you an idea of the person's liquidity at a particular point of time, because if you're saying liquid assets, so what are the liquid assets that he has given with respect to the liabilities that he has, right? Now, if you want to look at how leveraged you are or how much debt you have taken, so in that case you can have something like a debt to assets ratio, which means the total amount of debt that you have taken with regard to your assets. So at any given point of time, the lower the ratio you have, the better it is, right? Now this debt again can be broken up into short-term debt as well as long-term debt. So you may have long-term debt with regard to assets. Similarly, you may have something with regard to the kind of payments that you have to make with regard to your income. For example, all those compulsory debt payments that you have to make with regard to your income. So you know how much your income is there with regard to the kind of expenses that you have to make, right? And one particular ratio is basically the savings rate, which is the savings during the period divided by the disposable income. So that gives you an idea in terms of, right, how much of savings with regard to the disposable income. Now many times you have, for example, something like in terms of expenses ratio, which is basically the amount of monthly expenses that you have divided by the total amount of liquid assets. That means at a given point of time, suppose you have some amount of monthly incomes, how much of the liquid assets are there as a base to ensure that some amount of your expenses over a period of time is taken care of. For example, if you lose your job, right? So how much liquidity that you have would be able to cover you for how many months? So for example, if your monthly expenses are, let's say, 20,000 rupees per month, and you have within your cash and something like 60,000. So that means at least 3 months of your expenses are covered up by your assets. So at any given point of time, they say that you should have enough liquidity to cover at least 3 months of your expenses. If you are slightly more risk averse, then that ratio should be around 6 months. So a less risk averse person who is more confident about his job may just choose to keep only 3 months of reserves, where a person who is more not so confident would choose to keep something like 6 months, right? Now, while making a personal balance sheet and income statement, obviously there is a certain amount of documentation that one is required to keep on a regular basis. So for example, you may need to have all your bills into place, and you may need to keep a track record of all the expenses that you are making. So all your credit card statements, your bank statements, your income tax records, your stockbroker records, your deposit slips for your passbooks, right? All such records which have any bearing on the kind of income or expenditure that you are making, all those need to be kept, because only on the basis of those records can a person's income and expenditure statement can be recorded. Now, in terms of basic guidelines for creating personal financial statement, the assets and liabilities that one has, right? It should be based on accrual, right? And possibly the assets should be as far as possible recorded on the market value basis. But sometimes what happens is that you may not get figures, or the assets may not be liquid. In that case, it is always better to be conservative and then record it on historical cost, or basically on their liquidation value. If you have some sort of a business interest in a different venture, right, in a joint venture or something, then the proportionate amount of that business interest needs to be looked at, right? And anything which is open to loss or depreciation should be stated as minus the loss value. For example, if you are expecting to receive certain amount of income, but you feel that the person may not pay up, right, and you are reasonably certain that the full amount may not be paid. So when you are stating it on your balance sheet, should be stated at whatever was the full value minus the percentage that is possibly going to go back. Similarly, for assets which you may not have a secondary sale, and when you sell them maybe at a much discounted value. So to that extent, right, in that case those assets should be quoted at their maybe at their liquidation value instead of their current market value, because obviously if you choose to sell it, you will not get the full market value, or basically you should look at it at their depreciated value, right? For other assets which are basically financial securities and marketable securities, as far as possible one should state it at their market values. right? Similarly, for options and futures, if you don't have a market price for it, in that case, the underlying value of that asset, right, the time duration and the volatility, etc., should be taken into account while quoting a price for that asset. You also need to account for life insurance, pension values. So accordingly, you need to keep a judgment in terms of what the current market value is, what is their policy reserve. So that also needs to be accounted for. Right? I mean, at any given point of time, whatever financial statements you should make, it should be correct, transparent, as close to market reality as possible, and should be as accurate as possible. Only if they are accurate and done in a proper manner, only then can your financial situation be assessed correctly and completely. And for that, record keeping and documentation is extremely necessary.